Have you ever really wondered how an entire country keeps its books? I mean, we hear about GDP and trade deficits all the time, but there's a much bigger story. It's like this massive global financial checkup, and it reveals a nation's true wealth and how it deals with the rest of the world. So let's dive in. And we're going to start with a real head-scratcher, a paradox that's right at the heart of the global economy. How is it that the United States, the largest economy on the planet, also owes more money to the rest of the world than any other country in history? I mean, think about that. How is that even possible? Well, that's the mystery we're going to unravel right now. We're going to break this down into 4 simple parts. First, we'll start with a nation's basic economic checkup. Then, we'll look beyond GDP to see the whole picture. After that, we'll figure out how countries actually pay their bills. And finally, we'll get to what it really means to be a debtor or a creditor nation. Okay, let's start simple. To really get this, we first have to imagine a country that's totally sealed off from the rest of the world. No trade, no international investment. It's a closed economy. This helps us build the foundation for everything that comes next. So the very first thing you'd measure in this closed-off country is how much everyone is spending. We call this gross national expenditure, or G&E. And it's really just adding up 3 things: what people consume, what businesses invest, and what the government spends. You can pretty much think of it as the country's total shopping bill for the year. Now, inside our little bubble country, everything is in perfect harmony. Every single dollar that's spent is a dollar's worth of something that gets made, and every dollar of stuff that gets made turns into a dollar of income for someone. Expenditure, product, income, they're all exactly the same. It's a nice, neat little circle. But, of course, the real world, well, it's a whole lot messier than that. So let's open the borders. And this is where it gets really interesting, because now we have to keep track of all the money flowing in and out of the country, not just from buying and selling stuff, but from investments too. Okay, the first and most obvious flow of money is the trade balance. It's pretty straightforward. You take the value of everything a country sells to the world, its exports, and subtract the value of everything it buys from the world, its imports. If the number is positive, that's a trade surplus. If it's negative, it's a deficit. Simple as that. And this little adjustment is how we get to that number we hear about all the time, GDP. You just take what the country spends on itself, the G&E, and you add the trade balance. This gives you the total value of everything that was actually produced inside that country's borders. That's the gross domestic product. But wait, just producing stuff isn't the only way a nation earns money, right? Its people and its companies own things in other countries, stocks, bonds, factories, and those assets earn income. At the same time, foreigners own assets inside the country, and they earn income from them. The difference between what comes in and what goes out is called net factor income from abroad. Now, this is a really important step. When you take the GDP and add this net income from foreign assets, you get a totally different number, gross national income, or GNI. And this is a huge deal because GNI tells you the total income earned by a nation's people, no matter where in the world they earned it. Let's look at a real-world example of why this matters so much. Take a look at Ireland back during its Celtic Tiger economic boom. The country's GDP was exploding. Why? Mostly because foreign companies were setting up shop there. But here's the catch. A huge chunk of the profits from those operations was being sent back home to foreign investors. So the actual income of Irish citizens, their GNI, grew way, way slower than the country's GDP. Okay, so let's pull this all together. We've got the trade balance, we've got the net income from assets, and you can throw in smaller things like foreign aid. When you bundle all of those flows together, you get one master scorecard, the current account. It is the broadest, most complete measure of a country's income transactions with the rest of the world. All right, now we get to the real heart of the matter. We've looked at the income side of this global ledger, but what happens when that ledger is out of balance? How on earth does a country pay its bills? I mean, let's just think about it logically. If a country, just like a person, spends more money than it earns, it runs a deficit. For a nation, that means it has a current account deficit. So, where does that extra money come from? How do you cover the gap? The answer lies in the other side of the balance sheet, the financial account. It's the perfect mirror image. While the current account tracks flows of income, the financial account tracks trade and assets. We're talking stocks, bonds, real estate, entire companies. It's all about who's buying and selling ownership around the world. And here it is. This is the big aha moment, the fundamental rule of international economics, the balance of payments. It basically says the current account and the financial account have to balance each other out. They, along with a much smaller capital account, have to sum to zero. It's not a theory, it's an accounting identity. It always works. So if you're spending more than you earn, a current account deficit, you must be paying for it by selling off your assets, a financial account surplus. There's no other way.
So let's bring all this home. Now that we have these tools, we can finally understand what it really means for a nation to be a debtor or creditor, and what that actually says about its wealth.
So let's look at the actual numbers for the US back in 2015. You see it right there, a big negative current account. The US was spending way more than it earned from the rest of the world. So how'd it balance the books? Look at the financial account, a big positive number. In plain English, the US paid for its spending habits by selling its assets, stocks, bonds, property, to foreign investors. And this creates a really clear divide. On one side, you have creditor nations, like Japan. They tend to run current account surpluses. They earn more than they spend. And what do they do with the extra cash? They go out and buy up assets around the world. On the other side are debtor nations, like the US, who do the exact opposite. They run deficits and sell their own assets to pay for them. Over time, all these yearly flows add up, and the result is what we call external wealth. It's basically the nation's final balance sheet with the rest of the world. You just take all the foreign assets the country owns, and you subtract all the domestic assets that foreigners own. The result is the country's net worth on the world stage. And this brings us right back to the paradox that we started with. In 2015, America's external wealth was negative $7.4 trillion. That's the answer. The world's richest economy is also the world's biggest debtor, because for decades, it has spent more than it earned and paid for it by letting foreigners accumulate a massive ownership stake in the United States, trillions of dollars more than Americans own abroad. So we end on this big question. This whole system is a massive trade-off between today and tomorrow. By running a deficit and selling off its assets, a country gets to spend and consume more right now. But what does that do to its national wealth and to the income it's going to earn from the rest of the world in the future? That is the multi-trillion-dollar question at the very heart of the modern global economy.